Michael Burry is a highly successful investor renowned for his bold bets against the housing market that led to the great financial crisis. His hedge fund delivered outstanding returns of about 150 times the S&P 500 since its inception until shutdown in 2008. Recently, his latest holding has seen an impressive growth of 70% in the last 12 months, while the markets have, on average, dropped by 30%. While many active investors are content with beating the S&P by just 1 or 2% annually, Burry's track record makes him one of the best investors of our time. But these days, he mainly manages his personal fortune, and in this video, we are going to talk about what Michael Burry thinks of the investment market in 2023. Hey friends, welcome to Capitalista. Before we dive in, please take a moment to hit the like and subscribe buttons down below. And now, let's get started. One of his notable moves was successfully betting against Tesla and ARK Innovation ETF when their prices were very high. He also invested in GameStop before it became a meme stock. He wisely chose to go mostly into cash in 2022 as the market started to decline. He sold his positions in Meta Platforms and Bristol Myers before they went down and predicted high inflation by shifting his portfolio into real asset stocks. Lately, he's been using Twitter more and expressing concerns about the current rally. He's worried that people buy tech businesses just because they seem inexpensive compared to their peak. He even shared a 2001 and 2002 chart showing a similar temporary rally followed by a market decline. This leads him to believe that another correction is on the horizon. Following that, he shared a letter he wrote as a child that suggests the United States has accumulated too much debt and is financially struggling. Additionally, he recently tweeted the word sell, indicating that Burry has a negative outlook on the market's potential. Michael Burry and Jim Chanos are billionaires who believe the recent stock market rally will be brief. They both seem to be taking a short position on the market, betting stock prices will fall. Chanos recently went on CNBC to explain his reasoning. He said that even though the stock market's forward price to earnings ratio is currently 18 times, profits are at all-time highs, and he expects earnings to come back down at average levels. This, he says, will cause stock valuations to decrease. With inflation on the rise and interest rates skyrocketing, it's important to know how to navigate the upcoming recession and bear markets. Your first instinct may be to pull out of the market and hoard cash, but that might not be the best strategy. And even though Michael Burry, a well-known bear on stocks, seems to favor cash, he has voiced concerns about inflation and its impact on cash value. So, exploring your options before making any hasty decisions is important. Now, at the beginning of 2023, he cautioned that inflation hadn't peaked yet, as the last peak was almost in the double digits. This suggests that we may experience double-digit inflation rates soon. He's not just hoarding cash though. He invests in stocks that are resilient to recessions and have tangible assets, even if inflation persists and the economy struggles. More than 50% of his investment is in GEO and CXW, both of which were previously REITs that switched to C Corp for better capital retention. They possess private prisons which remain in demand even during recessions as crime rates tend to increase. Moreover, their assets are necessary for society, making them resistant to inflation. Now, constructing new buildings is costly, and as a result, the value of the current infrastructure increases due to the soaring replacement expenses. Furthermore, one of the significant holdings in his top 5 is Charter Communications, identified by the ticker CHTR. This firm possesses cable and fiber infrastructure, making it a business that relies heavily on tangible assets and is resistant to inflation and economic downturns. And according to recent updates, Burry has allocated a large portion of his investments of around 60% into 3 stocks rich in tangible assets. Additionally, he has shared his strategy of investing in farmland, which is also resistant to economic downturns and inflation. Additionally, Burry has clarified that when he refers to water in his tweet, he actually means farmland, indicating his positive outlook on tangible assets. Investing in such investments is now more accessible than ever, and Lowe's is an ideal choice in the current recession as a high-growth company with a long-standing record of consistent dividends. Lowe's stands out as an excellent company on Wall Street, having increased its dividend annually for 61 years even amidst challenging economic conditions such as 10 recessions, 2 financial crises, and high inflation and interest rates. Since 1946, Lowe's has has been a reliable company that shows no sign of slowing down. They've recruited top-notch executives from all over the corporate world to help them reach their goals. They aim to keep their payout ratio at a safe 35% and plan to increase their dividend by 14.3% annually for the next 5 years, which will nearly double its current size. Even better, they have a major trend working in their favor. Morgan Stanley predicts that 150 million younger people will become homeowners in the next 2 decades and renovate their properties. Lowe's is focusing on attracting professional contractors who buy in larger quantities, improving cash and flow stability to boost sales. Following the 2023 recession, Lowe's growth is projected to increase to 10% in 2024 and 13% in 2025. And if Lowe's meets expectations and returns to a fair value of 20 times earnings, its potential for return could almost triple, surpassing the NVO and the S&P. Let's talk about Lowe's long-term potential. According to 35 analysts, the company is predicted to have a median growth rate of 21%. This could mean great news for investors looking for solid returns similar to Warren Buffett's. Lowe's has a proven track record of delivering 400 times returns and 7% better annual returns than the market for almost 40 years. This equals a 145 times inflation-adjusted return compared to the S&P's 570 times. In fact, it has been able to generate 8.5 times better actual returns than the market. Its average rolling 12-month return is 22%, which is what analysts are predicting for the future. And unlike other global aristocrats, this ultra-quality swan dividend king is attractively priced, making it a promising investment opportunity. In the past, Lowe's has been valued at 20 times its earnings, but now it's trading at a discount of 26% at 14.4 times its earnings adjusted for cash. Its price-to-earnings growth ratio is 11.8 times, which is an excellent value for its growth potential. In short, Lowe's is a wise investment choice for those looking for high growth at a reasonable price. What's your take on Michael Burry's 2023 financial market forecast? Let me know what you think in the comment section down below. And that's it for today. We appreciate your support and hope you enjoyed the video. Don't forget to give us a thumbs up, hit the subscribe button, and turn on notifications so you never miss an upload from us. Your engagement helps us bring you even more exciting content in the future. Until next time, take care.